All right, everybody. Good afternoon. Welcome to a webinar that is a collaborative effort of 3P Financial, a company that facilitates retirement solutions for professionals, and Integris Pension Management Corp., a specialist pension administrator. Before we get deep in the weeds, I'm obligated to give a bit of a disclaimer. This webinar is intended for informational purposes only. It is not legal advice, nor is it financial planning advice, as your personal circumstances are unique. We are recording this webinar for your future review. If you ask a question, you are implicitly giving consent for your voice to be recorded and be available on our websites for others to listen to in the future. If you are not comfortable giving your name, please do not provide one, or just use your first name. Or send me an email, or you can send a text at the bottom of the screen. Notice at the bottom of the screen when you can opt to send a text to anybody or just to me. In no way are we encouraging or promoting any trade in any specific security in this webinar. 3P Financial is a division of McElvaine Investment Mangement Ltd. It is my great pleasure to introduce the CEO of Integris Pension Management Corp., Jean-Pierre Laporte, BA, MA, and JD. He goes by JP. He is a Diamond Jubilee award-winning pension lawyer who is a true expert in his field. He has many other accomplishments, but let's get on to the meat of this webinar and get started. We'll start with a short presentation and then go straight to Q&A. Welcome, JP, and thank you for your time.
Thank you, Lauren, and thank you to the folks at 3P Financial for this invitation to talk about personal pension plans today. Well, welcome, everyone. So I wanted to start off this presentation with what I call the big picture. Why are we here on a Saturday listening to pensions or information about pension plans? Well, the big picture is that we are now living in a world where governments are hungry for tax revenues, have increased tax brackets, and are closing down what they perceive as loopholes, including the use of professional corporation, especially in the context of medical doctors. We're also in a turbulent world in terms of markets and facing a lot of this instability. We know what's happening politically in the geopolitical world. There are population pressures, and there are also rapid technological changes that are making our life more and more complex. The new tax environment in particular is what we call the Marno tax measure, for short, the tax on split income, or TOSI, and the tax on passive investments for folks who keep monies inside of their corporations and invest them passively. These old ways of the old ways of saving for retirement using our professional corporation are being revisited because of this new tax environment. The government does have these strategies in their crosshairs, and so we need to find legitimate corporate tax deductions, because punting monies over to a holdco or keeping it in the medical professional corporation won't work anymore because of the new associated company rules that the federal government passed into legislation in the past year. The PPP is kind of the Marno after pill, a remedy against excessive taxation for people that have professional corporations as a way of organizing their business. So today, I really want to focus on the concept of pension inequality. And for those of you who might have watched on Netflix, there's a great series that my kids love and that I've watched a few times, called 3%. Much like in that series, the world of retirement savings in Canada is divided into two worlds. There's the pension world and the RSP world. So the RSP world is where 98% of most people find themselves. They will be using an RSP as a tax sheltered account to save for retirement. They might have other strategies like universal life policies, whole life policies, split dollar, critical insurance policies. There are all kinds of other insurance strategies, or the use of family trusts and so forth. But when they do use a tax-assisted savings account like an RSP, that's where they found themselves. And The nice thing about the RSP is you get a tax deduction for the contribution made. The assets are invested in a tax-sheltered account, so the growth is sheltered from taxation. There is some income splitting allowed starting at age 65 once you turn your RSP into a RIF. And folks who pass away and who have a spouse can give their spouse a rollover of those assets so that the spouse don't face an immediate tax consequence. So that's what the overwhelming majority of folks in Canada are in the RSP world. The pension world is for the 2% of Canadians who have discovered that the Income Tax Act has a number of provisions that they can utilize that are a lot more powerful than RSP rules. The registered pension plans go back to the first Income Tax Act in 1917. And they allow multiple tax deductions. Of course, the money is also tax sheltered. They're taxable on the way out, but income splitting can start as early as age 50, and the spousal rollover is also permitted. So when we're thinking about pensions in the context of today's presentation, we're going to be focusing on personal pension plans, which are registered pension plans that have this specific feature to them. They're made up of 3 components. So each PPP has 3 accounts. One is a defined benefit component, one is a defined contribution component, and one is an additional voluntary contribution component. And I won't get into all the specifics of what each account does at this point, but I will leave a lot of that for the Q&A later on. Suffice it to say that this typical structure allows us to put the most amount of corporate dollars into a tax shelter under Canadian law. So if we were to compare the 2 worlds, the RSP and the PPP, we know that the RSP gives us this year, in 2019, a maximum RSP contribution of $26,500. And unfortunately, that's pretty much it. If you decided instead to use an RSP, you decide to use a PPP, we'd start off with slightly more every year, which we call the annual advantage. And that advantage can be as low as $720 more. But as you get older, you can put up to $18,000 more than the $26,500 allowed in the RSP. So we call that the annual advantage. And if you were to look at what the limits look like graphically for someone, depending on their age, on this graph, you would see that the orange line, which is the defined benefit line, grows with age. So that's why there is this growth that's allowed in terms of annual contributions. The black line is the RSP limit. So as you see, it's fixed. It doesn't matter how much your salary is, you can't exceed that limit. But on top of the annual contribution, we can also, where possible, where applicable, buy back past service. So for those folks who have paid a salary out of their professional corporation in the past, there is the ability to purchase past service to increase the size of the pension benefit payable in retirement with additional dollars. Some of them come from one's RSPs, but the rest could come from the medical professional corporation. Then, in the first year, we can also do a double dip. We can also contribute to our RSP because the contributions to the RSP this year, in 2019, are based on 2018 earned income, whereas the annual contribution to the PPP in 2019 is based on 2019 pensionable salaries. So we have this overlap, which allows us to put a lot more money in the first year. If the assets are invested in a very conservative manner and do not return 7.5%, the law also allows us to make special payments. So the medical professional corporation can also contribute more money to the PPP in order to keep it fully funded, to make up for the difference between the actual rate of return and this target 7.5% rate of return that's prescribed by the income tax regulations. The investment management fees are also tax deductible in a pension situation because we're not dealing with RSP rules. Pension legislation is more permissive when it comes to investment management fees. If the medical professional corporation has to borrow money, the interest paid to the lender is also tax deductible over time. Cannot do that with an RSP, cannot do that with a TFSA. If one decides to retire before age 65, there is a massive tax deduction available called terminal funding that is given to the medical professional corporation to put enough money inside the pension plan to allow the retiring doctor to benefit from a much higher early retirement pension. And that pension amount is also fully indexed to inflation, to CPI, the cost of living. So these are all tax deductions which are completely foreign to the world of RRSPs. We also have a small $600 a year ongoing personal tax deduction available called the pension adjustment offset amount. We can also get the HST or GST, depending on the province, refund, which means that on the, for example, the investment management fees or other fees related to the plan, sales tax, a third of it can be refunded. Then at the tail end of the process, when the person eventually decides to retire, the annual pension that comes out can also be income split, and we can do that as early as age 50. Unlike the RSP where we have to wait until we're 65. And each person, including, so the member and the spouse, so together, can claim as a couple a $4,000 non-refundable pension amount deduction on their tax return, also starting at age 50 for those who decide to turn on the pension at an earlier stage. So, as you can see, the world of pensions is very different from the world of RSPs, and this has consequences. So this chart simply shows that if we're allowed to put more money each year, given all these extra tax deductions, assuming that the rate of return on assets is identical for both the RSP and the PPP, there will be a difference that builds up in the size of the registered assets available at retirement. So in this particular case, we have a 45-year-old doctor that has taken T4 income for 15 years. They pull out $140,000 in salary, but in the past only took out $100,000. Well, we can see that the same individual will end up with more than $1 million available at retirement in terms of extra registered assets. So I guess the contention today is it time for an upgrade? Do we want to stay in the RSP world, or do we want to upgrade to the pension world? And that's really an individual decision based on people's interest in having a real pension plan to rely upon and being able to deduct more money along the way. Now, aside from all of these tax advantages, personal pension plans also offer some other unique advantages. For example, we are the only company in the country that will allow you to use a corporate trustee to act as the fund holder of the pension plan. There used to be two other companies that were in this business, but they both pulled out of the market back in the end of 2016. So we offer that service, and it's only $300 a year, so extremely low cost to have a professional corporation that acts as trustee to hold on to the assets of the pension plan. We also provide fiduciary oversight, as we have pension lawyers on staff to deal with the inherent complexity of having a pension product. Remember, pensions are typically reserved for extremely large companies, and the law doesn't distinguish between a company with 10,000 employees and a medical professional corporation with a single doctor as the employee slash pension plan member. So we still have to deal with all the same paperwork, but we also give our clients access to a lot more tax deductions. And we have access to sophisticated products like GST rebates and access to alternatives. Now, one final sort of interesting feature of pension plans is that they also allow for what we call intergenerational wealth transfers. So unlike RRSPs, on the death of a PPP member in retirement, the assets are considered surplus, and surplus can be used to fund the future pension benefits of surviving plan members, so adult children that are working for the family business, which means that we end up with no deemed disposition the way that RRSP assets have to face, and no provincial probate fees. So if you were to look at an idea, sort of sample, sort of case study, here taken from the general practice, not particularly for doctors, but a lot of this can be applied very easily to doctors. If you have 2 older plan members and 2 younger plan members all drawing some T4 income from the family corporation, we can set up a personal pension plan in which we add all 4. And what happens is when the older folks decide to retire and start drawing on their pension, should disaster strike and they pass away, all the monies that were earmarked to pay those regular pensions are now considered pension because there's no one to pay them to. But because they're trapped inside of the personal pension plan, unlike an RSP, they're not subjected to the deemed disposition rules. They're not taxed. And because they don't flow through the estates of the deceased plan members, there's also no provincial probate to worry about. So now the 2 surviving plan members will win the jackpot and will be able to use those surplus dollars over time to pay for the building up of their own pensions. So that will give them an ability to use their parents' monies for their own retirement without creating an immediate tax consequence. And the way that we achieve all this to keep costs down and to automate this, because we know everybody's very busy, is we've developed a number of online tools that 3P uses in order to identify potential leads, folks that could benefit from the upgrade, and then we can run illustrations, provide a report, and then once folks have decided that it's time to leave the RSP world and join the 2%ers, then we can start doing online enrollment and gathering the rest of the information that we need to produce the legal documents that then allow us to put the plan in place. When it comes to fees, we always say at Integris that fees is a complete non-issue when people understand what is going on in the background. Because what is happening is that we have created, or we're giving folks access to a whole host of new tax deductions that didn't exist in the RSP world. And therefore, if we're able to claim larger deductions, that translates for the medical professional corporation, and sometimes for the doctor, into either tax refunds or tax savings. So monies that didn't exist before, that CRA can no longer hang on to. Well, out of that pool of brand new savings, of course, Integris will be levying its charges, but our fees are a tiny percentage of the new monies that are generated by having access to the pension world. So from day one, the solution ends up paying for itself many times over. So a discussion over fees is really, I mean, one can have one, but it's really not what should be determining whether or not to set up one of these structures. And I should say that the doctors of BC also give a subsidy for people who sign up for these types of plans. So that alone pays for our fees a couple of times over. but people may not be using that subsidy, or if they are, they might have already spent it. So really, this is the last slide. I wanted to say that most of the presentation was kept brief because the more important learning is done through the Q&A. So I'm going to stop speaking at this point and turn over the mic to Lauren.
Okay. Thanks, JP. That was fantastic. I'm going to ask a few questions. I'm going to let everybody else take a shot. I think it's important to ask about the advantages of a triple account plan with a delegated administrator, which is what the PPP is, compared to a generic individual pension plan, which is far more ubiquitous, far more well-known to accountants and to financial advisors, and the check that you cut every month, every year is less. So just outline the differences between what we're offering and what the generic, vanilla IPP is like, and the advantages.
Sure. Thank you. So the individual pension plan that's been around since about 1991 is a great product, but it's not as tax efficient as a personal pension plan because the triple account structure of the PPP gives us an edge over the IPP in a number of different dimensions. So the first one, of course, is the age advantage, and you'll remember the graph where you could see that younger folks were penalized vis-a-vis older folks, vis-a-vis those who are using an RRSP. So that's one advantage, but there's also the ability to double dip. So if we set up an RRSP and then later on an IPP, what we're missing out is on an extra deduction in the first year. So with us, if you are young, not only can you get your $26,000 defined contribution deduction, but you can also put your double dip to your RRSP. Whereas if you only did an RRSP when you're young, then you're missing out on a $26,000 additional deduction. So all those assets are not going to be growing tax sheltered if you stick to an RRSP plus IPP solution. So that's what we call the age advantage. Then we have what's called the excess surplus advantage. The problem with an IPP is that if the assets inside of the IPP do too well, perform too well, at some point we're going to cross over a certain threshold, and that threshold is 25% of the liabilities. So if we have too many assets in the plan, CRA forces us to take a contribution holiday, which means that the corporate deductions dry up. And to make matters worse, if you're adding another year of service to your IPP formula, that generates a pension adjustment. And the pension adjustment, its function is to reduce your eligible RRSP room. So that means, in layman's terms, that not only is the company unable to deduct, the doctor is unable to deduct personally by contributing to the RRSP. So we have a situation in an IPP where all tax deductions dry up. With a PPP, we have a solution for that because our client can switch and elect to move away from the defined benefit component of the plan, where we have this excess surplus problem, and move into the defined contribution side of the plan. And what that means is that while we won't be able to contribute to the defined contribution component or the third account, the additional voluntary contribution account, because we're not adding another year of credited service to the defined benefit formula, by implication, we're not generating any pension adjustments, except for a tiny little 1% of salary pension adjustment relating to the defined contribution component that we're using for that year. So that means we end up with 17% of our salary, or T for income, as a eligible RRSP contribution. That means we can, the doctor, for example, can contribute up to 17% of the salary into the RRSP, get a personal tax deduction, which couldn't happen in the IPP context, and then roll that RSP money into the plan through the additional voluntary contribution account on a tax-free basis, so that the company can continue to pay the investment management fees, and we can claim the GST credit, and of course the money is creditor protected, and et cetera, et cetera. So that's what we call the excess surplus advantage. Then we have a third advantage that the PPP has over the IPP, and that advantage is what we call smarter asset allocation. So what that means is that in an IPP, unfortunately, it's one single account, and think of it as a soup with different kinds of asset classes with different inherent rates of return. So if you have GICs, I guess you'd be lucky to get 2-3%. If you have some bonds, you might get 4 or 5% return. If you have some income stocks, you might be pushing 6, 7, 8. And if you have growth stocks, speculative stuff, you might be pushing 10, 12, whatever, depending. And I'm just pulling numbers out of thin air, but you get the picture. When you aggregate all of these different classes of assets in a single IPP pool, they start canceling each other, so that the overall rate of return for the pool might be around 6, 7, 7.5%, 8%, and so forth. What that does is that it severely restricts the additional tax-deductible special payments that a medical professional corporation could put in if the internal rate of return was lower. So that's the general basic principle. Now with a PPP, what we can do is we can say contributions going into the defined benefit account will be invested in highly secure, lower yielding asset classes like your GICs and your bonds. And the more speculative stuff that we expect would have a higher rate of return or expected rate of return, we'd invest in the other two accounts, the DC and ABC account. And the reason why this makes sense is because when the actuary, every 3 years typically, comes in and does evaluation of the health of the plan, they will look at the returns inside the defined benefit account, much like they would have done had this been an IPP, and they will ignore the rates of returns in the other two accounts. It's ignored from the calculation. So if all we have are GICs earning 2%, and the assets inside of that account should have been growing at 7.5%, well, that creates a massive special payment opportunity for the medical professional corporation. But what we've done is we've still taken into consideration the overall portfolio requirements of the plan member, because we haven't gone all GICs. There's still stocks and stocks and growth stocks in the other two accounts to create the entire portfolio. So by respecting the client's wishes, we've optimized the corporate tax deductions to the medical professional corporation. And another way to think of it is, let's say the MPC is taxed corporately at 25%, and I'm able to put another $10,000 because I have a large special payment obligation that I've manufactured by going into super conservative asset classes. Well, that's $2,500 in taxes that I've saved, because normally it would have gone to the CRA. So it's almost like a guaranteed 25% rate of return, which is not a bad thing to find in the markets these days. The other advantage that the PPP has over the IPP comes from what happens when eventually we decide to pull the plug on the pension plan and decide to push the money out into a locked-in retirement account or a life income fund or some other vehicle for saving. Because of course, once we pull the plug on a pension plan, the money has to be pushed out and dispersed. So in an IPP, and this is, I don't want to pick on IPPs because it also applies to the defined benefit component of the PPP and to all defined benefit plans in Canada, so it's a general rule. There is a particular regulation under the income tax regulation that says only a portion of that pool of money can flow and roll into a locked-in retirement account, a life income fund, etc., tax sheltered. Anything above that cutoff point is considered like a cash payment, and there's personal tax owing on that amount. The reason why the PPP can assist with that particular rule is that if someone knows that they're going to be retiring in a few years, we can amend the pension plan rules and say and increase the required employer contribution under the defined contribution component from the basic off-the-shelf 1% all the way up to 18%. And what we do is we would be using surplus that is sitting in the defined benefit account to cross-subsidize and roll it over into the defined contribution account. And you might be wondering, well, that sounds a little fishy. Where did this come from? It's a practice called cross-subsidization that has been going on for decades, but the Supreme Court of Canada in the Carey Canada case blessed this and said this is purely, it's completely legal and acceptable as a practice for pension plans. So by skimming away defined benefit dollars that normally we would be subjected to tax and putting it into the defined contribution account, what happens is when you pull the plug on the PPP, anything that's sitting in the defined contribution account can roll 100% tax sheltered into the LIRA or life income fund, and there'll be less defined benefit dollars exposed to that immediate taxation. So if this is done, let's say 4 years ahead of planned termination, and someone is taxed to the highest tax margin or bracket, you know, you could conceivably look at a $50,000 tax saving because you can put at least $25,000 each year in the defined contribution component. It'd actually be more than that, but I'm just using round numbers. So those are all, Lauren, these are all the extra tax advantages that the PPP has over the IPP. There's another one that is specific to provinces like BC, where under IPP rules, so long as you're a connected person and you own at least 10% of your company, there is no actual obligation to fund an IPP. And so, again, while that may sound good on the surface, it does mean that our PPP clients are better off because let's say that for whatever reason, someone does not want to contribute to their IPP in a given year. If they're adding another year of credited service to the IPP formula because they're collecting a salary and the plan is still ongoing, it hasn't been shut down, we're still generating a pension adjustment. And this is one of the oddities of pension legislation, is that when you have a defined benefit plan, the size of the pension adjustment, meaning how bad your RSP room will be depleted, has no bearing on the actual contributions made by the company to the pension plan. So even though the company put zero and deducted zero, you still end up having an impaired RSP room because of the pension adjustment that's been generated. So the PPP client who doesn't want the company to make a contribution can still use the defined contribution and ABC side of the plan and contribute to their additional voluntary contribution account. So the company would have to put a tiny 1% of salary, but then it opens up the ability to contribute 17% of salary to the additional voluntary contribution account and get a personal tax deduction. So you can see that over time, even if the objective is to reduce the commitment of the medical corporation towards the pension plan, the PPP client in BC gets more tax sheltering going on. So that's it for the tax advantages, and then you have the non-tax advantages of the PPP over the IPP, some of which I've already alluded to in the presentation: the ability to have a corporate trustee, and the fiduciary oversight provided by the Integris folks, in addition to the actuarial team provided by our partner Industrial Alliance. So you end up with almost 20 professionals working to supervise and administer the day-to-day workings of the pension plan in a very integrated way, with what we call fiduciary oversight. So we have a legal responsibility to act in the best interest of the doctor as a plan member, which the folks that offer administration services for IPPs do not have this legal obligation. So it's kind of the analogy that I use. It's like playing hockey with an IPP and just actuaries. You get everybody except the goalie playing on the team, and with us you get everybody plus the goalie, because we feel that if you want to have a top-notch pension plan, you need to have the proper staffing, and that's why the personal pension plan is designed to mimic the way that the most sophisticated pension plans in the country are built.
That's great, JP. That's the most thorough answer I think I've ever heard. Thank you. That's awesome. I'm just going to ask one more question, and then I'm going to open it up. I've got a bunch of it here, but I'm kind of hogging you. But I was asked this recently, and I'm not entirely sure what the answer is. If I have a number of employees that work for my corporation that are not my family, and what is my obligation to offer a pension to those employees?
Well, there is no obligation at all.
So I can pick and choose. I could offer one to my CFO, to my secretary, and exclude my one of the clerks. Okay.
Well, yeah. So the way that pension legislation works is it's by classes of employee. So if you say the eligible class of employees to be in this particular PPP is all the CFOs of the company, well, there would only be one person that would meet that criteria, or criterion, I guess. So that would be the CFO. So okay. you can create classes of employees and discriminate amongst them. But in order to maintain the tax advantageous treatment, whereby the plan remains outside of the jurisdiction of the Pension Benefit Standards Act of British Columbia, and you're not forced to file with the Financial Commission, you don't have to make special payments if you don't want to, you'd want to make sure that membership is only given to people that are connected persons, so people that own at least 10% of the shares of the company, or who are married to shareholders, or sons or daughters of shareholders, of connected persons. Okay. So that would make it difficult to want to give it to rank and file employees that maybe you like. It's possible, but it's just more expensive, and there are more things that need to be put in place to protect you or your company.
Great. Guys, you guys can go off mute now, and feel free to chime in, or else just send me a text and I'll ask on your behalf. Does anybody have a question for JP? No?
Oh, it's Shu here. I'm not sure if you can hear me.
Yes,
we can.
Oh, terrific. Well, thanks for organizing this. I've enjoyed learning about it since Lauren introduced the concept a few months ago to me. I fired a few questions at David, but I'll just ask them. First question is, is there a certain amount, because I have the good fortune of having a UBC pension, so is there a certain amount that my corporation has to be able to do to make it all worthwhile? I don't retain a lot in my corporation because I have children in university.
Well, thank you for your question. I mean, the whole point of personal pension plans is to shelter surplus dollars that after you've paid your expenses and taken some money as salary is left over in the corporation, and that you don't want to keep investing in a passive way within the corporation. So if in your particular case, at the end of the day, after you paid for the university and all the other expenses, there's virtually nothing left to save, then in that case, PPP would not make much sense. But for most professionals that we've been dealing with over the past 6 years, there's usually a good $40,000, $50,000 that's still left over as a retained earning that could be extracted out of the company after salaries and other expenses are tabulated. And so it's that surplus that we can mop up with the PPP and cleanse out of the business and dump into a tax-sheltered pension plan.
Now, if in the future, if somebody like Shu, his cash flow situation changes, which is likely for him, past service will still start to accrue, and he would be able to, in the future, buy back all those years that he didn't contribute. Correct?
That's correct. That's correct. And as you know, you can start really low in terms of the ongoing contributions. You can start at 1% of salary. If cash flow is tight in the first few years, you can always start with a very low, modest 1% of salary under the defined contribution component of the plan. And then, as you said, Lauren, later on, you can convert those defined contribution years back into defined benefit years and do a retroactive purchase of past service. So now that the company has more cash a few years later, we can catch up, play catch up, and claim much higher tax deductions and match it to when the company has more cash flow. So you can always start very small and then notionally build up a reserve, and at the end of the day, when there is a liquidity event or more cash coming in, do a catch-up payment.
That's great. The other question, you might have alluded to this, the Docs of BC, they do that, they match your RSP contribution and you get some additional sort of top-up, longevity top-up or something. Can those be applied to the PPP?
Yeah. Yeah, it's on the form. It says IPP. You just give the IPP registration number that we would give you.
The same form, Shu. Yeah, it's the same form. You just click, you tick a little box and you put the IPP number. And then it's the same.
And then last question that I can think of, does having a PPP in any way complicate your estate? I mean, apart from the example you gave where you can pass on pensionable, pensions to, family members, but presuming that your family's not involved at all, is there any sort of dissolution of the PPP that complicates the estate?
No, because what happens is under pension law, the law has very strict rules as to who gets to get the money. And there are two types of deaths under pension law. There's what we call pre-retirement death. So that's a death occurring while you're in the accumulation phase, meaning you haven't started drawing your pension. And then there's post-retirement death when you are a pensioner. So under the pre-retirement death situation, what happens is if you were to pass away and you had a spouse, all the money inside the pension plan would flow to the spouse on a rollover basis. So no income tax consequence to anyone in the family. If you did not have a spouse, or maybe the spouse for whatever reason had waived the entitlement to receive this pre-retirement death benefit, then what happens is the next tier on the totem pole is the designated beneficiaries on record. So we would have a list of, let's say, the children or favorite charity or whatever. And then based on the percentage selected by the plan member, the cash in the pension plan would be split amongst the designated beneficiaries, and then it would be taxable in their hands. It's only if there's no spouse or a waiver and there's no designated beneficiaries that are alive that it drops into the estate. And then in that case, it's added to the pool and subjected to the usual estate rules. So that's the pre-retirement death situation. In the post-retirement death situation, meaning you've already started drawing your pension, again, if you have a spouse at the time of death, the pension is a joint and survivor pension. So the spouse continues to collect what the plan member was collecting as a pensioner. So sure, the joint and survivor pension paid to the spouse is taxable, but so is an RRSP or RIF payment, and no consequence for the estate and or the kids or anyone else. If both pass away, which can happen, you know, you have your car accidents and all this, then the money that's left in the plan is considered pension surplus, as per the illustration that I gave in my presentation. So under the PPP pension surplus rules, there's a bunch of things that can happen then. One is surplus can always go back to the company, to the MPC. It would be taxable as an investment gain to the company. However, if in that year the company has tax losses, those losses could be used to negate the taxes from the return of the capital, and therefore the MPC would end up with the cash without having to pay tax on it, or very little tax, or whatever the numbers are. So that's one option, and we call that a surplus reversion. Another option is that whoever's in charge of the MPC after the death, whether it's the trustee for the estate trustee, the executor, or whoever, maybe it's the kids that's taken over, they could also declare a free distribution of surplus and have that surplus paid to the beneficiaries like themselves, the kids. So that would be taxable in the hands of the recipients of the surplus. But, you know, if you have a lot of recipients, you end up doing some income splitting in a way. So lots of options with respect to the money, but it always stays in the family. There isn't any leakage per se.
Great, thanks.
Thanks, Hugh. Does anybody else have any other questions for JP?
There's always the question, hey, what happens if Integris goes bankrupt? What happens to my money? Maybe we can ask that one. We always get that question. We always get that question, which is one of my favorites, because it's a real concern that people think, oh my gosh, you know, I never heard of Integris, I never heard of PPP. Can I trust these guys? You know, what happens if something happens to this company? This is my life savings. So anyway, this is a legitimate question that we get all the time, and we've been getting for the past 5 to 6 years. Well, the answer is that the PPP was designed to be quote-unquote nuclear proof, in the sense that it's designed to resist even the insolvency or bankruptcy of Integris. And let me explain why that is, why there is no consequence, really. First of all, the medical professional corporation that adopts a PPP really controls and owns that plan document. So nothing prevents it from the next day filing a plan amendment with the government and saying, I'm converting this back to a regular IPP. Or I'm going to shut it down and terminate the entire thing and take the money out and move it to a LIRA or to a LIF or buy an annuity with it and just go on with my life and just wash my hands of the structure. So that's number one. The company, the NPC, runs the show. Second potential risk is, well, where are the assets held? Well, they're not held at Integris, I can tell you that. They would be with the corporate trustee, and then they would be invested by the 3P folks. So it's not like we are making decisions as to whether the cash should be invested in this particular stock or unit of a fund or cash position. We don't touch the money. We have no ability to direct how the investments are allocated. So no risk of a Bernie Madoff here. And of course, we don't even hold on to the cash. So it's not like, let's say, creditors came knocking on my door and said, hey, we want money, we want assets of yours. We don't have those assets. They're held in trust, in a pension trust, with a third-party custodian, a corporate trustee. So this is the most secure money in Canada. And even in terms of the actuarial administration services that we offer through our partnership with Industrial Alliance. Now, just for those of you who don't know Industrial Alliance, it's the fourth largest life insurance company in Canada. It's been around for 126 years. It has 5,500 employees coast to coast and 4 million clients. So that's the partner we have to make sure that the paperwork for the plan is filed on time and all the calculations are done correctly. So that's our back office. So even if, for whatever reason, a doctor didn't like the service, they can fire us and then go to an actuarial service provider and say, hey, I need an actuary to file these papers for me. Can you do it? And of course, that person would be more than happy to get a client. So doesn't matter how you look at it, we've designed this structure to be what I call nuclear proof, to ensure that our clients' money is always kept secure.
I was also going to mention that there's a custodian, which is usually a chartered bank, that holds the assets at both the level of the pension, and then there's one at the level of a fund. So sometimes there's two custodians, both there. The job is also to hold assets.
That's right. Good point.
JP, I just got a question from one of my colleagues. He's asking, the buyback, which can be very large, I'm just turning 51, and mine is calculated about $125,000. And if I didn't have cash on hand to finance that, or I didn't want to borrow money to finance that, could I do that in the future some point?
Yes. So that's a great question, because a lot of folks think that when you have an IPP or a PPP, you have to buy back all the past service on day one and when you set up a plan. That is not true. If you want to, you can, but it's hyper flexible, because not only do you not have to recognize the past service, but if you do want to recognize past service, you could recognize only a fraction of it up front. Let's say you had 10 years of salary and you could buy back 10 years. You could say, no, I'm only going to buy back 3 years now, and then maybe 10 years later I'll buy back the other 7 years. So that's how much of the past service you recognize is one level of flexibility. And then the other level of flexibility is that even if you were to recognize all 10 years up front, and in your case it's over $100,000 corporate tax deduction, you don't have to fund it right away. If you don't have the cash on hand, you can amortize and pay down that $100,000 obligation over time. So you have a second layer of flexibility through amortization. Any other questions?
If there's time, I'll ask one more question. It's Shu again. I have a very senior accountant and a very senior kind of guy who manages my investments. And I was not entirely surprised, but the accountant was very skeptical and suspicious and didn't necessarily understand the concept. Is this something you encounter frequently, that people aren't familiar with it or don't trust it? Like, what are the reasons that people don't like this?
Yeah, well, I can let Lawrence definitely talk about that point, but let me say that this is a normal reaction. We've heard a lot of very senior tax people say, this is too good to be true. Government's going to shut it down when they realize how generous this is. I mean, we've heard them all, because what happens, unfortunately, is that the expertise that is specific to pensions is housed in the Canadian economy with governments and very, very large companies, the ones that can afford to provide registered pension plans. So accountants that do not deal with those types of clients, that deal with the smaller clients, like the individuals, even if they're business owners, they do not, unfortunately, and that's just a fact of life, they don't have the expertise to assess the structure, and therefore they do a back of the envelope, well, I don't know, it seems too good to be true, or I'd be careful, and then they kind of brush it off. So that's just the way it is. It's because what we've done is we're like Prometheus, you know, we're bringing the fire from the gods to the humans. You know, we're taking the rules that govern extremely large pension plans that have been around for decades, sometimes a century, and we're bringing it to the retail small business owner, like the incorporated doctor market. And of course, you know, the rules are the same, but the people are not used to it. It's so foreign that the first reaction is, hey, be careful. And you can never go wrong by saying be careful. Because if you go ahead and set it up, they'll say, yeah, I told you to be careful. I'm happy it's working for you. And if something were to go wrong, they'd say, I told you to be careful. So it doesn't matter what happens. The accountant who said no is always winning, and you know, that's expected. But you know, what we're saying is you got to be able to come up to your own conclusions and do your own due diligence and get the facts, not from competitors of ours, but from third parties who are impartial, and say, you know, check it out. Look under the hood. Did CRA approve this? You know, what is Integris? Who's behind it? Who's behind 3P? You know, do the due diligence, and then come to your own conclusions.
I have a comment, JP. When I did the presentation at Oak Bay last month, afterwards, a accountant who was in the audience came up and spoke to me and said that, I won't say which firm it is, but at Toronto, the head office, they were in negotiations to bring PPPs to their accountants all across the country. So so this is a major accounting firm that is planning to adopt them whole scale. Anyway, that's sort of interesting. I imagine that more and more accountants will become familiar with them because they'll have them themselves. But let me move on to another couple of questions because we're eating up some time. Can you hear me okay?
Yep.
Can you hear me okay?
Yeah, I can hear you.
Can you guys hear me? Oh, okay. The government seems to be increasingly hostile towards Canadian-controlled professional corporations. Maybe it's just my imagination, but it seems that they're quite hostile. And what's stopping them from just shutting this whole thing down, just like legislating the PPP out of existence? Sure.
Well, to be honest, I mean, I'm a lawyer, right? So the first thing you learn in law school is that Parliament is supreme, and if they wanted to, they could legislate that a dog is a cat, and that would be the law of the land, and the courts would enforce it. So anything's possible. and there's nothing that prevents the government from doing whatever it wants. However, that being said, that general principle being said, there are a number of reasons that militate against and attack against the PPP. The first thing to keep in mind is that every single dollar that's generated by a PPP as a pension is taxable. So it's not like we're dealing with universal life policies where the money becomes tax-free or tax-free savings account. It's taxable money. It's just pent-up future tax revenues that are accumulating inside of these PPPs. The second thing to keep in mind is that those same pension dollars paid out in retirement also provide a 100% clawback against public pensions like the old age security pension and the guaranteed income supplement. So in effect, what the government is doing by allowing PPPs is they're slowly transferring the burden of retirement away from the public taxpayer through these publicly funded pension programs onto the shoulders of the private taxpayer through their own personal pension plan savings. So they're actually saving money because the more pension dollars generated at the PPPs, the less people can claim those public pensions. So there's actually a public policy imperative. The third thing is a lot of the development capital in Canada comes from pension plans. So I don't know if you guys have followed in the news, but often the federal government is looking to pension plans to finance infrastructure developments and things of that nature, because it's the only place where you can get big chunks of money to do large capital-intensive projects. So there is another public policy reason for protecting and fostering pensions. The other thing is the rules that we use are the same exact rules that are found in the public sector pension plans, the teacher pension plans across the country, the unionized pension plans. So all of these different constituencies, which are very important voting blocks, all rely on the same rules as the PPP. So while it's always possible for the government to say, okay, we in the public sector who actually need your tax dollars to fund our pensions, we're going to keep these amazing defined benefit pension plans for ourselves. But you guys in the private sector, you guys who try to copy us with a PPP, we're going to shut you down and you won't be able to use registered pension plans for yourselves. Again, it's possible, but my feeling on that is that politically it would be very explosive to pit Canadians against each other like that and to favor only public sector workers against the people that are paying taxes for the public sector's pension plans. And the last consideration is, and this is more of a joke, but you know, Mr. Morneau and his family own a pension consulting firm. So maybe going after pensions is not the first thing he's going to do. But then again, who knows what's going to happen after October.
Thank you. I think I take most comfort in that last one. I just got a message asking, what about if you have a spouse who is a participant in the plan and they run off with the beach boy, or do they remain in the plan? Can you add a new spouse? That's the question verbatim.
That's a good one. Is this like specific to BC?
Nope.
Okay. Beach Boys? Okay. Well, I mean, the spouse is the spouse. So if the spouse is no longer the spouse, so if you divorce the spouse or they're no longer living with you and qualify as a spouse, then the new person in your life would qualify as a spouse, and that's the person who would be entitled to the death benefits or the survivor pension.
they would have a claim on the assets within the pension at the time of divorce.
The new person who is living with the plan member, not the ex-spouse that's run off with the beach boy, but the new person that qualifies as a spouse would be the one that would be the claimant.
But as part of the divorce proceedings and settlement, he or she would have a claim on your pension assets accumulated to date. Am I right? Just as you divorce, as part of the divorce settlement, they still, unlike other creditors, the divorcee has a claim.
Again, you know, as you said in your disclaimer, each individual situation is unique. If there is a divorce and the person that used to be the spouse is no longer the spouse, they may have a residual claim over family property under division by the court or other pension division mechanisms. So each province has its own family law sort of proceedings and particular regulations as to how the couple's money is split. But if you have a new spouse, because that person is out of the picture, it's the new person who would, for example, get the death benefit if you were to pass away. So you might have, in these types of situations, you might have two claims on the pool. One that's because of the past and the divorce settlement, and then the current spouse who would step into your shoes if you pass away with whatever is left in the plan. Right, so let's say you start off with $1 million in a plan, spouse one divorces, and under the judgment is entitled to half the money. So there's only $500,000 left. But then you have a new spouse, and 2 days later, due to all looking at the legal bills, you pass away from a heart attack. The new spouse would be the one that would get the death benefit, and the rollover of the $500,000 would go into that spouse's RRSP.
Very depressing conversation. If there is, this is a question, you alluded to this earlier, but it's worth repeating. It goes, what's wrong with waiting until you get you're older to start a PPP? Can you just pay into an RSP from 30 to 50 and then PPP after 50? So in other words, I'm interpreting this from somebody else's question. What's the advantage of starting really early, even before the DB contribution exceeds the RSP contribution at about age 38 to 40?
Right. So, well, first of all, you can you have to double dip. So if you only do an RSP when you're young and then later on start an IPP, you're missing out on the ability to double dip, to put money in your pension plan and in your RSP in the first year. So you're missing out on all this tax shelter growth of that extra $26,000, and you're missing out on the tax refund generated by having contributed to your RSP and investing that, let's say, in a tax-free savings account for X number of years. So all of that capital you're just given up because you decide to do the RSP first. The other thing you do is you also miss out on the time value of money, because the more capital you put in when you're young, there is this this compounding effect that really starts to pay off over time the longer you're invested. So what I always say to people is, try to get as many tax deductions as soon as possible. Don't restrict yourself to the RSP when you're young to just catch up later on, because $1 in 10 years from now is not the same value as a tax dollar sheltered now. It doesn't have the same weight. So it's not a simple one-to-one comparison. You have to factor in the depreciation of money and the growth of that money in a tax-sheltered environment.
And also, the tax deductibility of the MER is another big one, I think, don't you? So during that, if you started at 18, you set up a PPP, contributed only to your DC, then during all those years, you can tax deduct the any management expenses that you have on your investment.
Well, that's a big one. There's also, if you had to borrow money, you can write off the interest. There's the GST credit. There's all these other incidental, I mean, they can add up over time, that you're kind of giving away because you refuse to get to leave the 98% RSP world and join the 2% pension world. And remember, fees is irrelevant because the Doctors of BC will pay for our fees a couple times over anyway, and you have all the other tax advantages that come with a pension plan that you don't have with the pure RSP. So if fees is not on the table, then the question is, what is really the importance? What's the important factor? Is it being able to put as much capital as possible in a tax shelter, or not? And remember that when you transfer money from the medical professional corporation into the PPP, you're also protecting yourself from the more no tax measures relating to the tax on passive investments. So you're also protecting your $500,000 small business allowance and protecting the corporate tax rate of the company. So that's something that we don't even think about sometimes, but it really adds up. I mean, one of the big impetus for PPPs is this particular rule.
That's fantastic. Now, what if I want to retire but not draw my pension right away?
Yeah, well, you don't have to retire until you turn 71. So you can opt for deferred retirement and push the start of the pension at 71. So that's one solution. Another solution is to freeze the plan and say, well, I'm just going to put it on ice for a while and just live off of dividends. There's also the ability to, and I think there's an advantage to retiring early, because retirement in the pension world doesn't mean going to the golf course or doing whatever you guys do in DC. It just means that you're no longer collecting T4 income salary from the MPC, and you now switch over to dividends to pay for your living expenses. You can still work. You can still show up to the clinic or the hospital or whatever particular activity you have and collect dividends. But now the pension's been torn out, so it kind of replaces part of the dividends you used to get or part of the salary you used to get. But now you're eligible for pension income splitting. And you're eligible for the massive corporate tax deduction that's generated by terminal funding, the ability to turn on the pension sooner with an unreduced amount indexed to inflation. So in my mind, while most people think of turning on the pension as late as possible because they're afraid that it's just going to add more taxable income, it could be act as a substitute for part of the income you're drawing out of the business every year for living expenses. It's just recharacterized.
I think this is one of the most attractive parts to me, because one of the problems that plagues us in the latter quarter of our career is the inability to slow down our practice, because our overhead is constantly rising and our revenues drop. This happened to my father, who was a retired neurosurgeon. And with an ability to retire early but continue working and drawing dividends, and drawing a partial pension allows you to take off time or work part of a week and remain solvent. That is one of the most powerful things from my perspective. I just want to open it up to any other questions before we close, because we're going on to an hour and a half here. Anybody want to have final questions for JP? Anybody? Like, call-in user 3 is trying to say something. I can see they're trying to speak, but it's not coming through for some reason.
Lauren, perhaps one question I have is, oh, here we go. Someone's joining?
No, it's a call-in user 3. He or she is trying to speak, but it's not coming through for some reason. You can see that they're speaking.
One question may be, what if people have more questions? What's the best way to get them answered?
That's a good question.
That's for you, Lauren.
Yes. Well, almost everybody on this call knows me personally and has no problem getting hold of me. But if you send questions to info@3pfinancial.com, we will answer them to the best of our ability. And if we don't know the answer, we will find out. We have access to JP. He works like a doctor 7 days a week. It's like working 14 hours a day. He's incredibly accessible, and his staff are top-notch. So obviously, you know how to get a hold of that resource via 3P. If nobody else has any other questions, we'll wrap it up. We will, once it's been edited, this recording will be available. We'll put a link on it to our website. I'll send it out via email to our contacts. And it's been very valuable. JP, thanks for being so detailed and such a valuable resource.
Oh, my pleasure. And thank you, everyone, for those who were able to attend and those who will listen to this later on.
Good night. Have a good afternoon. Bye-bye.
Bye-bye.